Today, we will talk about emerging market economy definition, how it works, and examples. An emerging market economy is the economy of a developing nation that is becoming more engaged with global markets as it grows. Countries classified as emerging market economies are those with some, but not all, of the characteristics of a developed market. As an emerging market economy develops, it typically becomes more integrated with the global economy. That means it can have increased liquidity in local debt and equity markets, increased trade volume and foreign direct investment. It can develop modern financial and regulatory institutions. Currently, some notable emerging market economies include India, Mexico, Russia, Pakistan, Saudi Arabia, China, and Brazil. Critically, an emerging market economy is transitioning from a low-income, less developed, often pre-industrial economy towards a modern, industrial economy with a higher standard of living. Investors seek out emerging markets for the prospect of high returns because these markets often experience faster economic growth as measured by gross domestic product. However, along with higher returns usually comes much greater risk. This risk can include political instability, domestic infrastructure problems, currency volatility, and illiquid equity, as many large companies may still be state-run or private. Also, local stock exchanges may not offer liquid markets to outside investors. Emerging markets generally do not have as highly developed market and regulatory institutions as those found in developed nations. Market efficiency and strict standards in accounting and securities regulation are generally not on par with advanced economies. However, emerging markets typically have a physical financial infrastructure, including banks, a stock exchange, and a unified currency. A key aspect of emerging market economies is that over time, they adopt reforms and institutions like those of modern developed countries. This promotes economic growth. Emerging market economies are classified in different ways by different observers. Levels of income, quality of financial systems, and growth rates are all popular criteria, but the exact list of emerging market economies can vary depending on who you ask. For example, the International Monetary Fund classifies 20 countries as emerging markets, while Morgan Stanley Capital International, MSCI, classifies 24 countries as emerging markets. Standard & Poor's, S&P, FTSE Russell, and Dow Jones also vary slightly in their classification of countries as emerging markets. Here are 5 key takeaways. 1. An emerging market economy is an economy that's transitioning into a developed economy. 2. Emerging market economies typically feature a unified currency, stock market, and banking system. They're in the process of industrializing. 3. Emerging market economies can offer greater returns to investors due to their rapid growth. 4. They also offer greater exposure to some inherent risks due to their status. 5. Over time, emerging markets typically adopt reforms seen in developed markets. Hope this would help. Thanks for watching.